Should my 401k contributions be Roth or traditional? There are many considerations that may make my response different for different people. Now, a large part of this decision relates to income tax treatment of each. So a traditional 401k allows me to contribute dollars before they're taxed. No tax occurs while they're invested, and then all future withdrawals from this account will then be taxable. A Roth is kind of the opposite in that all contributions are made with dollars that have already been taxed. Again, no tax occurs while they're invested, but then future qualified withdrawals are then income tax free. So let's just look at the basic math differences between the two. Let's say I've been able to commit $10,000 per year from my budget to contribute to my traditional 401k. And let's say this $10,000 as it's invested increases in value by 100% over a long period of time before I need the cash in retirement. The balance is now $20,000. Assuming my future tax rate is 25%, I'll then owe $5,000 in tax and have the remaining $15,000 left to spend. Okay, now let's assume I decide instead to make Roth 401k contributions today. Assuming my current tax rate is 25%, I only have $7,500 to contribute today because I first must pay tax on that $10,000. Assuming this money is invested the same way as in the traditional example, it grows by 100% before I need to withdraw the cash in retirement. Now the balance now is $15,000. Since qualified Roth withdrawals are income tax free, the entire $15,000 is available to spend. So, assuming my income tax rate today is the same as it will be when I need the money in retirement, I end up with the same amount of spendable cash, $15,000, in both examples. Now, isn't that interesting? What we haven't considered, however, in this example, is the complexity of today's income tax code. Just as one example, Social Security benefits may or may not be subject to federal income tax depending on other income on my tax return. Qualified Roth withdrawals are not reported as income on my tax return, so those withdrawals would not cause any additional tax on my Social Security, whereas taxable traditional 401k withdrawals may possibly create more tax on my Social Security income. There are many other details and considerations surrounding this decision, but a comparison of my tax rate today versus my future tax rate when I plan to withdraw the money may be a good indicator of which to choose. If I think my tax rate today is higher than it will be, well then I may choose the traditional contribution today. A lot of people think that's going to be the case, but it's not always the case. We have another video on that topic. But if I think my future tax rate may be higher, then Roth contributions may be wise today. Maybe I even choose to split my bets, so to speak, by contributing some Roth and some traditional. It's also important to know that current law requires employer contributions to my 401k to be traditional. So even if all my contributions are Roth, my employer's cannot be. So the dollars contributed by my employer and of course any growth on those dollars, will always be taxable when withdrawn in the future. So I hope that's given you something to think about. Be wise in your tax planning, and remember, Uncle Sam isn't really your uncle.